welcome to our third economic and industry update brought to you by Greenbrier's marketing team. I'm Mallory Moran and I'm joined by Jay Carter. Thank you to everyone that provided feedback on the previous videos. We hope you'll find this one helpful too. Now, the gross domestic product is one of the broadest measures of goods and services produced. So let's start there, Jay. How is GDP?
Well, thanks, Mallory, and I am glad to be back with you again. So regarding GDP, we're continuing to see a strengthening U.S. economy. In fact, GDP grew 6.5% in the second quarter, which is higher than the pre-pandemic levels. Overall, GDP is on target to meet the upward revision of 6.7% growth in 2021.
What sparked this growth?
I'd say most of the growth has been fueled by government stimulus and consumer spending, particularly as people received vaccinations and businesses reopened.
Then I assume there's an economic risk associated with the spread of the Delta variant?
Well, there could be. So far the new COVID restrictions are limited, but could curtail spending on travel and experiences. However, a side note is that consumer durable spending has stayed strong and could experience a boost,
which could increase rail demand. And that's a great segue, Jay. Will you please walk us through some rail metrics?
Sure. Let's talk about rail volume. So currently, North American rail volumes are up 12.2% year over year. And to put that in perspective, that's roughly a 400 basis point improvement since we last met a few months ago.
That's really remarkable. And it's partly driven by those record-setting intermodal and grain traffic reports that we've all seen. And those are big figures, but how are volumes compared to a more normal year, say like in 2019?
Yeah, that's a good perspective to, kind of put volumes in. While loading patterns of 2019 and 2021 are significantly different, the current traffic rates are actually nearly identical.
Well, what about rail cars and storage? It was a really high figure a year ago. What's it like now, Jay?
Well, I got good news on that. There are currently about 360,000 rail cars in storage, which is a significant difference from last year. And it's well below the frictional level of 400,000 units. And we expect this figure to continue to decline, although at a slower pace. Some rail car types are already at full utilization, whereas other rail car types are scrap candidates.
What about rail velocity?
Yeah, velocity is down roughly 9% year to date from last year. And this is mostly driven by traffic gains, port congestion, and shortages of both labor and equipment.
That's a lot of factors then affecting velocity. And I'm sure that the unpredictability of commodities has played a part too. Will you walk us through what you're monitoring?
Sure. Steel prices, I think steel prices have been on everybody's radar. They continue to have a huge impact on rail car orders. The price of hot rolled coiled steel is roughly 3.5 times its price last year. We anticipated this to stabilize as auto manufacturers closed for the summer for retooling and due to chip shortages. However, we really haven't seen this manifest, and steel manufacturers haven't brought more mills online.
Well, I'm sure steel will continue to be a headwind for a while. Are there any other commodities that you're following?
Yes, crude oil. So we know that the Keystone Pipeline was canceled in June. However, WTI is forecasted to reach over $100 per barrel by 2022. And this could really make crude by rail economically feasible.
Well, now something that we don't talk a lot about, Jay, but it does indirectly impact the rail industry. It's trucking. How is trucking capacity?
Well, trucking capacity is very, very tight right now. And actually, there are about 60,000 drivers needed to meet current demand. And we anticipate this figure to be even higher because the 60,000 number is what has been registered by the clearinghouse.
Well, and I'm sure those higher crew prices you were talking about, that will play a factor as well.
Oh, definitely. Higher diesel prices combined with inflated truck spot rates will for sure push demand towards rail. And we just have seen container shortages. Oh, just as we've seen container shortages, there are significant trucking equipment shortages as well. The chip shortage is affecting truck production, and the lack of trailers, chassis, and drayage equipment further stresses the market.
Well, let's hope many of those stresses lead shippers to rail. Any final thoughts, Jay?
Yes, two things. The first is pertaining to rail car loadings. Overall loadings are up strong compared to last year. However, in the second half of this year, we should see smaller volume gains due to tougher comparisons from the second half of last year. But overall, we expect that loadings to be up this year above last year. And the second one is inflation, inflation, inflation. Everybody's talking about inflation. And we've seen the inflationary pressures heat up a little bit, reflecting increases in consumer prices. The thing I would say is that it's important to view inflation over time. So the current inflation is actually in line with historic values, and partially due to the pandemic and supply chain issues. So the inflation of today really isn't the same as the inflation experienced in the 1960s and the 1970s.
Those are both great points. Thank you, Jay. And thank you all for joining us. We hope you find this video valuable. Now be sure to check out next quarter's edition.